Welcome along everyone to this Squirrel webinar. Today we're going to be talking about Reserve Bank's deposit compensation scheme. Wonderful disclosure statement there that you're welcome to read when we post this up on YouTube. So go have a look at the Squirrel YouTube channel and you should see it up there. We'll also email everyone over time or during the course of next week, let you know once it's up. Today's agenda. First of all, we're going to go through a few slides on understanding the Reserve Bank's deposit compensation scheme, and I'll give you some scenarios on what that's all about. I'll go through what Squirrel's position is in relation to the deposit compensation scheme, and then I'll give you my opinion on the scheme overall. Last but not least, we'll move into the Q&A section. Love for you to ask questions. It makes the webinar, so don't be afraid to post questions in the Q&A section, and it's okay to start adding them while I'm talking or going through slides. It'll take me sort of 15 to 20 minutes to go through the slides that I've got, and then we'll move into Q&A. If you have feedback for me on today's session, don't be afraid to email me on dave@squirrel.co.nz. And if you've got follow-up questions in relation to the scheme, please email them to money@squirrel.co.nz and we'll answer those for you. All right, let's move on. The deposit compensation scheme explained. So what is the compensation? So the compensation is up to $100,000 if an insured deposit taker fails that you hold funds with. The $100,000 is for each entity and for each covered deposit taker. Two parts to that sentence, let me explain. So first of all, what is an entity? That's a person, a trust, or a company. And then who is a covered deposit taker? Well, that's organisations that are regulated by the Reserve Bank of New Zealand and are participating in the scheme, of which there's 29, and I'll actually show you the list of those later on in the presentation. So both banks and non-bank deposit takers are eligible, but you do have to be regulated by the Reserve Bank in order to be eligible, which I think seems fair. Things that are not covered, so KiwiSaver is not covered, other super schemes aren't covered, foreign currency accounts aren't covered, and bonds or fixed interest investments aren't covered either. The cover starts from the 1st of July 2025 and it includes existing deposits. So if you've got, for example, a term investment with a bank today, which matures in December, from the 1st of July, it's already covered. You don't need to do anything different. The coverage just commences. If you are looking for more information, go to the Reserve Bank's website and in the search bar, just type in deposit compensation scheme. Reserve Bank has lots of material in there which you'll be able to use and should answer any questions that I don't answer along the way today. Last but not least on this page is the Squirrel position, which is a little nuanced. So first of all, for our on-call account, we are covered by the fact that BNZ and Westpac are part of the deposit compensation scheme, and we hold the money on trust, and that means that you do actually have cover, and I'll explain a bit more about how that works later in the slide deck. And it is a little complex at times, so don't be afraid to ask questions on that. For our managed funds and our term investments, they are not covered under the deposit compensation scheme, and I'll talk about why that is as we go through the presentation. Okay, so let's move into some scenarios. So first scenario in the box on the left-hand side of the page. So we've got a person holds $75,000 with Bank A and $125,000 with a non-bank deposit taker. That means they have full cover with Bank A, because remember it's up to $100,000 per institution. And the non-bank deposit taker, let's assume they're also covered, which means they're covered up to 100K, even though they hold 125. So that means across this person's portfolio of 200,000, 175,000 is covered and 25,000 is not covered as it stands. If we contrast that with the scenario on the right-hand side of the page, The person has split their deposits 100,000 each to Bank A and a non-bank deposit taker. That's covered, which means they'll get full cover under both. So they've got 200,000 in their portfolio, all of which is covered. Okay, that was the easy one. Let's move on to the next. What happens if you have a joint account? So I guess this is a common scenario. If you've got a joint account, then it's 100,000 covered each per institution. So for Bank A, they hold 150,000 there, which means they've got full cover because remember it's 200,000 for that institution for each of the, oh, sorry, 100,000 for each person, so 200 in total. And then for Bank B, they hold 250,000 there, of which they'll have 200,000 covered. So they've got a portfolio of 400,000, 350,000 of which is covered, 50,000 not covered. On the right-hand side, they've split their deposits evenly, 200,000 each between those two banks, which means they've got full cover on that 400,000. Okay, so I guess what you're learning from these last two slides is that if you split your deposits with no more than a maximum of 100,000, it means you can get covered or full cover across those different institutions. Okay, a little more complicated. So let's say my wife and I, we have a joint account together. We hold money with both Bank C and non-bank deposit taker, both of whom are covered. We also are trustees of the wonderful and excitingly titled Tyrer Family Trust. So let's look at the scenario here. So first of all, on the joint accounts on the left-hand side, once again, 200,000 covered for each of those two institutions, if only I had that much money in the bank. So total or full cover is in place. There's also money held in the Tyrer Family Trust. For that entity, it has 100,000 cover per institution as well. So you can see that actually across a total portfolio of 600,000, some of which is held in joint names and some held in a family trust, you actually have full coverage in place. I've used only two organizations in each of my examples. You can expand that. So there could be four different banks and non-bank deposit takers that you hold money with, all of whom will provide you with that 100,000 cover. So who is covered? Who are the various deposit takers that are covered? You can see there's 29 across this group. I've highlighted the major banks, all of whom have participated along with the minor banks. And then you can see there's a range of building societies, credit unions, and finance companies that are also part of the scheme. Okay, I can see no one's asked any questions yet, so I must be doing an awesome job. Let's keep going. Squirrel's position. So let's talk through what Squirrel's position is. First of all, the on-call account. So you're covered up to 200,000, courtesy of the fact that we hold funds on trust for you with both BNZ and Westpac, and look through applies. So look through means that because we hold the money on trust, both BNZ and Westpac, in theory, can look through to your holdings with Squirrel, which means you get covered. So there's three different scenarios that could play out, each of which I've noted on the left-hand side of the slide. First of all, if you hold no money directly with BNZ or Westpac, so let's say you've got your banking with KiwiBank, just for argument's sake, and you don't have money with anyone else, then in that situation, you actually have $200,000 in total covered in your Squirrel on-call account. That gives you 100,000 coverage with BNZ or up to, and up to 100,000 covered via Westpac. All of the money that Squirrel or that you have held in the Squirrel on-call account is divvied up roughly 50-50 with BNZ and Westpac. All right, so first of all, if you don't have money held with BNZ or Westpac, then you've got up to 200,000 covered in the Squirrel on-call account. So that's a happy days scenario. Second point or second example, if you hold money directly with BNZ or with Westpac, so one or the other, 50% of your holdings will count towards your cover with that institution. The other 50% will be covered, and that's the example that I'll give you on the right-hand side in a moment. Third scenario is if you hold money at both BNZ and Westpac, all your funds count towards your cover. So let's work through scenario two, which is on the right-hand side of the page. So let's say Dave banks with BNZ, holds money with Squirrel on call, and holds no money at Westpac directly. So in that situation, I've said 50,000 is held directly with BNZ, and doesn't matter whether it's in transaction accounts, savings accounts, or term investments. Collectively, I hold 50,000 at BNZ. I've got 150,000 in total in my Squirrel on call account, 50% of which goes to BNZ and 50% of which goes to Westpac, which means I have a maximum of $50,000 covered under BNZ. So if BNZ were to fail, not that I'm expecting that to happen, however, if they were, then you have up to 100,000 covered with BNZ, which means 25,000 of the money that you have in your Squirrel on call account won't be covered. With Westpac, because I don't hold any money directly with Westpac, then actually the full 75,000 or 50% of my holdings is covered. Okay, this is the most complicated scenario I could devise today. So that's a really complicated one. But in essence, I've got 50,000 with BNZ, 150,000 with Squirrel. That means under BNZ, I have 100,000 covered. Under Westpac, I have 75,000 covered because I don't have any other holdings with Westpac, which means overall in my portfolio, 175,000 is covered and 25,000 not covered. Okay. I can see someone's asked a question. Perhaps it's on this. I appreciate this as a slightly complex scenario. Don't be afraid to ask other questions if you think there's things I haven't explained or other ways to explain it. Moving on to Squirrel's term investments and managed funds. They are not covered under the deposit compensation scheme, so that's really clear and easy to understand. Squirrel is regulated by the Financial Markets Authority under a peer-to-peer license. We're not regulated by the Reserve Bank. Squirrel has no plan to change its license to be a bank or a non-bank deposit taker, and therefore we won't be able to have coverage under the DCS for our term investments or managed funds. Okay. What we do offer, though, is obviously great returns with the support of our reserve funds in place. We've lent over $1 billion life to date. And while we can't predict the future, no investor has lost a cent in almost 10 years in business at this point. Okay, so that's our position relating to our term investments and managed funds. All right, time for some opinions. So what might happen in the market? So let's say the scheme arrives, kicks into gear on the 1st of July. What might banks do? Generally speaking, in my opinion, banks will try to recover the cost, which is effectively the premium they're going to pay the Reserve Bank for having this scheme in place. For the big banks, that's going to work out at 5 basis points. So they're going to try and effectively reduce their deposit rates or increase their lending rates or some combination thereof, so that ultimately it's customers who are being covered, and therefore they believe customers should wear that risk. So in my opinion, banks will try to recover the cost of that premium that they need to pay to the Reserve Bank for that cover by adjusting their interest rates appropriately. It may not be obvious when they do it, so they could make all sorts of changes to their term investments, and it would be very hard to track over time. It would be much clearer if it was, if, for example, they just reduced their savings rates by 5 basis points or increased their lending rates by 5 basis points as of the 1st of July. However, I doubt that's going to happen. I think you're going to see this play out in their term investment pricing and in their fixed rate lending pricing. Finance companies are likely to reduce their investment interest rates, and in my opinion, that has already started. Watching various players in the market and the movements that they've made with their investment interest rates recently. So I think that's already underway. I'll talk more about that in a moment. For credit unions and building societies, I haven't been paying a huge amount of attention to what they've been doing, and I'm not sure how they're going to respond. It's a wait and see on that one for me. What happens if there is a failure? So while I think it's highly unlikely that New Zealand Bank will fail anytime soon, There's always a higher risk for a non-bank deposit taker to fail, albeit not that I can see any failing in the very near future. If one of those covered institutions does fail, it will be messy. It will be messy for the failed deposit taker. So you can imagine the shenanigans that might be going on within that organization as they go through a failure event. And equally, the Reserve Bank will have wonderful plans in place. Wonderful plans will get beaten up as soon as they get taken into battle, so to speak. So it will be messy. And as a consequence of it being messy inside the organization, messy for the Reserve Bank, it'll also be messy for investors. So the Reserve Bank, I know, has done quite a lot of planning for what happens if a failure occurs. However, the best laid plans can easily go awry once they need to be put into action. And often there is a lot of time pressure when that occurs. So very easy for things to go wrong. So don't expect a really clean a failure event would be the way to describe it, I think. Here are some other thoughts. And Squirrel's been quite vocal on this, both through blogs that we've written, podcasts that we've made, and submissions that we made to the Reserve Bank when they were considering this scheme. So the cost of coverage for non-bank deposit takers, NBDTs, is only 0.2% for the highest risk provider in the market or highest risk non-bank deposit taker. Yet typically in the market, until recently, they've been paying at least 2% in addition to what the banks pay to raise deposit and investment funding. So why is it that the Reserve Bank is effectively charging them a tenth of what they've been paying to raise deposits? In my opinion, the Reserve Bank is subsidizing risk-taking behavior. It doesn't sound like a good thing. For those of you who have been around a while and remember the global financial crisis and the impacts in New Zealand, if you look at what happened with South Canterbury Finance during the GFC, that shows the clear moral hazard that exists in this space. Um, I'll briefly explain for those that may not have seen that or didn't understand it at the time. South Canterbury Finance was heading towards failure. During the GFC, the Reserve Bank then applied a deposit guarantee, which they applied to all of the organisations that they regulated. Um, After that happened, South Canterbury Finance continued paying really high interest rates on the investments that are offered. A whole lot of money that was then guaranteed flowed to South Canterbury Finance, and ultimately the organisation failed. And there's a book written by a reasonably well-known financial advisor called The $1 Billion Bonfire. If you want to read more about that, go hunt it out. So that's the first point that I'd make. I think that the pricing for entry into the scheme is mispriced. Second point that I'd make is the Reserve Bank thinks that the DCS is going to increase lending competition. My opinion, in the prime lending market, so let's say, vanilla home loans, regular business loans, I don't expect any change to take place. I think that market will continue to function pretty much as it is now, and not a lot's going to happen. In the non-prime lending market, we may see an increase in competition. So I referenced before that I think I've seen a few of the finance companies start to reduce their deposit interest rates already, which I can understand that behavior. The question will be, will that lead to more competition for lending and interest rates effectively coming down or being competed away? Or will they simply try and increase their profit margin? Or will it be some combination of both? I suspect it'll be some combination of both. However, yeah, so in the prime lending market, I don't think it's going to make much of a difference, if anything. In the non-prime market, you may see a difference because the playing field's going to shift, where you've got some players in that non-prime market who are covered by the deposit compensation scheme and some who are not. And that will change interest rates and pricing, in my opinion, that are offered both on the deposit side and on the lending side. So look out for that. Third point, All right, Reserve Bank's made New Zealand banks quite a bit more conservative, particularly post GST and over time. So, main banks today are actually relatively conservative in their lending. Um, Ultimately, then, does the DCS add any rational peace of mind, given it's likely depositors will end up with marginally lower returns as a consequence? Will you actually feel happier if they are covered? I don't know. Clearly, for some investors, they'll feel much more comfortable and they'll spread their deposits. But I suspect for many, they actually probably won't pay too much attention on the assumption that they're holding money at main banks. If you're going outside main banks, then I would say there's likely to be ceilings in place of 100,000 for many investors to make sure that that cover exists. The other point that I would make would be non-bank deposit takers. I believe they should face higher prudential hurdles, and it's possible that they will, given that they're now covered under this scheme. So, if you're the Reserve Bank, the organisations most likely to fail are those with lower credit ratings, which will be in that non-bank deposit taker sector, whether it's building societies, credit unions, or finance companies. Um, so if that's where the probability of a credit event is most likely, then you would say you'd want to increase the amount of supervision that you're providing across that group. That could lead to increased costs for those lenders. So wait and see. All right, so there's some opinions on what I believe might play out in the market. First of all, question from Sarah. Is the scheme the equivalent of the FDIC in the US? How is this new in New Zealand? Has there been no such insurance or government backup to banks in New Zealand at all before now? Okay, few different types of questions in there, Sarah. I'll try and pick them off one at a time. Is the scheme the equivalent of the FDIC in the US? At the highest possible level, the answer is yes. In the minutiae, or if you get into the detail, each scheme will have its own rules. And deposit insurance exists in lots of different countries around the world. Each will have its own nuances about, for example, the amount that's covered, what happens for different people and entities, the way companies are covered or not covered, all those sorts of things. So reserve banks tried to use in New Zealand relatively simple rules on who's covered, how much you're covered for, and tried to keep it as simple as possible. And I actually think they've done a pretty good job of trying to keep that simplicity there. Each different regime around the world will have its own nuances, but in effect, they're doing the same type of thing. This is a new scheme in New Zealand. The only time we've seen the government effectively guarantee deposits in past history is during the global financial crisis. So during that period, then banks were covered and finance companies were also covered. So basically the same rules that we have now, where if you were regulated by the Reserve Bank, you were effectively covered. If you think back to that GFC period, the most glaringly obvious problem that came up with the deposit guarantee scheme, as it was called at the time, was with South Canterbury Finance. So for those of you with a long memory and remember back to what happened during the problems that South Canterbury Finance had, they'd had some lending that went bad to a large degree. They saw a lot of their investors removing money from them as an organisation. The government guarantee was then introduced for South Canterbury Finance. A whole lot more money went into South Canterbury Finance, and ultimately the organisation failed. So there's a situation where a lot of money was paid out by the Reserve Bank to effectively cover that, or through the government really, who backed it. So has this been used in New Zealand before? The answer is yes, for a short period during the global financial crisis. I was actually at ANZ at the time and was responsible for helping calculate the amount that ANZ paid to the Reserve Bank or through to the government for that scheme. Back to South Canterbury Finance for a second. There was a book that's interesting if you want to read it, called The $1 Billion Bonfire, which recounts what happened during that period. and the moral hazard that played out because that scheme existed. Now, I think there's a third part to your question, Sarah. Let me have a look. There's been no such insurance going to be. The other element to your question there is, has there been an implicit government guarantee for banks in New Zealand? I won't say for finance companies, but certainly for big banks. You'd say the answer is yes, and that's demonstrated by behaviour. So we've seen BNZ Bank was bailed out twice in the 80s and early 90s from memory. Westpac got pretty close at one point through the early 90s period. And if you recall back to that, if you've got long memories or have been around for a while, you recall New Zealand had a really severe recession that lasted from sort of not long after the 1987 share market crash through into the early 90s. And there was quite a bit of commercial property that went bad that BNZ and Westpac had lent on during that period. So there was an implicit government guarantee that has probably existed for a long, long time behind big banks. Now the Reserve Bank and government are effectively saying that does not exist, but we do have this deposit compensation scheme that does exist. So leverage that. All right. Sarah, hopefully that answers your questions. Feel free to add additional questions if I didn't quite capture those for you. Next question. Does the Open Bank Resolution Scheme continue to operate for bank liquidation alongside the DCS? The answer to that is yes. So they're two separate pieces of regulation. So open banking resolution and the deposit compensation scheme, they exist side by side and effectively do different things. So open banking resolution at a high level, what that does is says if a bank fails, effectively the Reserve Bank will step in, haircut depositors and then reopen the bank the next day. So that's one part. The second part is the deposit compensation scheme. If you hold less than 100,000 with that bank as an individual or a company or a trust, then you're actually going to get that whole 100,000 covered. So you're not going to get a haircut in that situation. So both pieces of regulation still exist side by side and treat people or treat investors in different ways depending on their situation. Thank you for that question and quite a complex answer there. Question from Casper. Is the 50-50 BNZ Westpac holdings for Squirrel on call actual fact or hypothetical? No, it's actual. We literally hold on any given day roughly half the money with BNZ and the other half roughly with Westpac. So the number will bounce around a little bit, but that does actually mean you have that protection at 50-50. And I'm getting into hypotheticals here, so please remember that this is hypothetical. If we thought that BNZ or Westpac were about to fail, chances are Squirrel would move all of the money into the bank that we didn't expect to fail's accounts. So, we still don't want our investors to go through the trouble of trying to claim money back through that scheme, because I suspect it would be really, really messy. So yeah, that's a very hypothetical thing, but in the normal run of business, Squirrel holds about 50% of the money with BNZ and about 50% with Westpac. That'll balance a little bit between the two day to day. And yeah, so that's our position. It's not hypothetical, it's actual fact. The balances are held with those two banks. There's a second part to Casper's question. Does just having an account with them reduce the protection to 50% of what? So that is, if you think, what I'm going to do is I'm going to go back on the slides to that example. Bear with me. And we'll talk it through again. Okay, so remember, this is the example. So I'm going to use myself. I hold $50,000 with BNZ directly in transaction account and savings accounts and term investments, and I hold $150,000 with Squirrel in the on-call account. In that situation, because I've got $50,000 held directly with BNZ, the maximum cover I can have from the Squirrel on-call account is $50,000 from that 50% holding. Okay, so if I hold 150 75,000 with Squirrel, then that means 75,000 is allocated to BNZ and 75,000 is allocated to Westpac. Because I've already got 50,000 with BNZ, that means I only get a maximum amount of cover of 50,000 effectively on that BNZ participation in the deposit compensation scheme. So hopefully I've re-explained it, Casper, in a slightly different way, and hopefully that makes that a little bit clearer. Next question from Richard. RBNZ thinks the DCS will increase lending competition. You think mostly for subprime borrowers. Will Squirrel lending rates or popularity of peer-to-peer shift as a result of the DCS generally? Well, let's talk it through. I think for prime lending, you're not going to see any changes in the market. That would be my expectation. So when I say prime lending, what does that mean? That means mum and dad who have a home loan with BNZ, Westpac, ANZ, any of the major banks really, could be Cooperative Bank, wherever it happens to be, and it's on normal, regular terms. We also know in the market that there is, I'm going to say circa 5 to 6 billion of lending that is done where it could be still first mortgages, but it's not done under standard bank credit policy. So different things. So that's where Squirrel plays. So we play on the edge of what a bank's prepared to write. And there's a whole raft of players that play in and around that 5 billion of loans, give or take, that we would call non-prime part of the market. So in that non-prime part of the market, I've already seen behaviour from some of the finance companies that are covered by this scheme, reducing their investment rates. So if they reduce their investment rates, they've got two decisions they can then make, or they've got a decision to make about whether they reduce their lending rates or they keep their lending rates where they are and they take a fatter margin. I suspect the answer to that question will be they'll do a bit of both. So they may well reduce their lending interest rates to try and attract more borrowers and try and grow their loan book. Equally though, they will also try and fatten their margins and literally make more money. That's the behaviour that I expect we're going to see in the market. So what does that mean for Squirrel, given we can't participate in this scheme for our peer-to-peer lending and for our managed funds? Well, over time, that may mean that we have to shift our rates of return down a little bit relative to where they are against banks today, to make sure that we can still offer borrowers or still be able to compete in the market. Today, we don't have any problems competing. It's going to take sort of 3 to 6 months for this to play itself out. And so the real answer to that question, Richard, is probably going to be found in about 3 to 6 months. So for now, Squirrel manages to compete and raise enough loans to meet investor demand, or high quality loans to meet investor demand. We won't compromise on our credit standards. We will have to manage our pricing possibly over time, but a lot of it depends on how those other players that are covered compete. So you've got a range of players that are covered by this DCS that play in that non-prime space, and you've got a range of players that also play in that non-prime space who can't get covered. So that kind of split in the market may lead to some interesting outcomes. But in the prime space, I don't think anything will happen. Thanks for that question, Richard. Excellent question. Thank you. All righty. Question from Natalie. Can I explain how LVRs work in the development loan area? Is LVR based on bare land only? Okay, so this question, LVRs, so loan to value ratio, and how this plays out in the construction space. So what do we look at? Let's explain what a loan to value ratio is first of all. So let's say a property is worth $1 million. The loan to value ratios, and so $1 million property, let's say Squirrel's lent 500,000 on that property, then the loan to value ratio would be 50% in that situation. Okay. For a construction project, then the LVR gets a little more interesting because let's say there's a house on a piece of land today. The intention is the developer buys that house. They're going to remove that house off the property. So it then turns into kind of bare land. And then they're going to construct, let's say, 3 townhouses on that piece of land. How do we think about the loan to value ratio? All right. So first of all, on the assumption, and we'll know this from the developer, that they intend to clear the house quickly and get on with construction quickly, then the loan to value ratio that we calculate is on the end value or the finished value of that property. So what is the 3 townhouses worth at market rate versus the value of the loan? Okay, so that's how we calculate the loan to value ratio in that situation. We also look at a whole range of other things. So we might look at the cost to complete the project and look at the value of the loan relative to the cost to complete it. We want to make sure that a developer has hurt money in there. So we don't want to fund them for more than, certainly not more than the cost to complete the project, and typically quite a bit less. So we also look at the loan to cost ratio on a project as part of our thinking about how much money the developer needs to have in a particular project. The loan to value ratio that we will have on loans in our portfolio will vary quite a bit. So for construction, occasionally we've got a developer in there who is doing a land hold for a period of time. It could be bare land. In that situation, the maximum we would go to is either 50% or 60%. And there's a few nuances on the type of situation. So we have a lower loan to value ratio threshold that we work to where land is going to be held as a land bank for a period of time. And typically that's sometime longer than 3 months. So, and typically they might be, sort of 9 to 12 months. And it could be while a developer's going through consenting. So in that situation, we look at the value of the land only and lend at an LVR of 50%. Or in some situations 60%, depending on the situation. Compared to a developer who's buying a piece of land that has an existing house on it, they're going to knock it over and get on with construction straight away. Typically in that scenario, we might go to 70% or a maximum of 70%. If that property is pre-sold, then we might go to 80% or a maximum of 80% loan to value ratio. You probably got a bit more than you bargained for there, Natalie. Hopefully that answers your question, though. Feel free to ask a follow-up. A question from Brian. When will PI certificates be available? I actually followed up with our fund administrator on that the other day. I don't have an answer back, but Brian, I'll make sure that if they're not going to be out before the end of May, that I let investors know. Okay, so my expectation is they'll be available before the end of May. If they're not, I will let you know and give you an ETA. Brian, you'll be able to find those, and for any of our investors who invest in our managed funds, you'll be able to find them by going to the reporting section of our app or our website, or once you've logged in, and then you'll see there's a menu item there for tax certificate. So that's where it will exist once they're available. In the typical course of business, I would have thought they would have been there by now, Brian, which is why I've followed up with our fund administrator. Thank you. Follow-up question from Natalie. Are you beginning to see more competition for lending from finance companies? Is there downward pressure on lending interest rates? I think so. A couple of answers there, Natalie. I haven't particularly seen additional competition yet, although I suspect it will be coming unless they've got really greedy and they've just fattened up their margins. So that's entirely possible. So my expectation is we will see a bit more competition in that space. We're also in, I guess, a fluctuating interest rate environment. So because interest rates are moving around all the time, it can be hard to get a really good gauge on just how much competition is there. As we run through the course of this year and the OCR stops moving, which, could be sort of either 12 to 16 weeks from now, at that point when things stabilize, I think it'll be much easier to get a good gauge on whether we've seen competition in the market increase or pricing pressure start to come to bear. So I can't answer that question for you now, but I suspect it will become clearer over that next sort of 3 to 6 months. Thanks, Natalie, for that question. Oh, another question's just popped in from Matthew. Any plan to offer PI term deposits? At the moment, Matthew, no. And in the medium term, probably not. I think the fact that the monthly income fund is taxed under the PI system and is delivering a return of around 6.5% at the moment, which is similar to our construction loan term investments, then I think actually we've got a pretty good coverage on that front. So no plan to put in a PI term deposit. Sorry, Matthew, at this stage. Who knows what might happen in the future, but for now, no plans. Thank you. A question from Natalie. I see some loans that are in arrears in the construction loan portfolio. How concerned am I by that? So if you go onto our website, in the view performance area, you can go and have a look at a graph which shows you the number of loans that are either in arrears or over term. The vast majority of those loans, Natalie, are over term, which means the developer is still making payments on their loans, but they haven't repaid the loan yet. I think you're going to see that start to move downwards over the next 6 to 8 weeks. So I'm not particularly concerned about those loans in that portfolio. I'm not expecting any losses to come through from them. We are monitoring. Clearly, we're in touch with all of those borrowers. At this point, no particular concerns. Clearly, we want to see that number come down, though. That's probably higher than what I'd want to see in the portfolio, and it's just partly a sign of the market. It's been slower for new properties to sell in various parts of the country, which means that sometimes a loan will run over term. Occasionally, we'll rewrite some of those loans and get them back square, depending on the situation. And sometimes it's good to have the developer hurting a little bit, knowing that there's default interest applied, and it's encouraging them to sell. So we'll keeping a pretty close eye on that. But at this stage, no loans that we're expecting to take losses on in that portfolio. And even if there was a loss, that's what the reserve funds are there for. That's that shock absorber, an important part of our wider proposition about how we manage that. So yeah, I do expect that that number will start to come down a little over time. Thanks, Natalie. Question from Sarah. So was this scheme the reason for recent move in the OCR, or was it something else driving it at the moment? Sarah, the deposit compensation scheme is completely disconnected from movements in the OCR. The Reserve Bank's been thinking about this and working on it since sometime post GFC. It finally got onto their agenda about 2 years ago, between 2 and 3 years ago. And they've been working on it since then with various players in the market. Squirrel actually made a submission to the Reserve Bank when they called for public submissions. So it's not connected with the OCR in any way. Thanks for that question, Sarah. Question from Alan. If the reserve funds build up, is there scope for the return of some of that money to investors? So let's talk about our personal loan portfolio and what's happened there, Alan. So that personal loan portfolio has been around, or started in 2015. That's when we wrote our first loan. That reserve fund has about $1.1 million in it, and the total personal loan portfolio today is around about 7 million. That has a huge amount of coverage. For those that have invested in personal loans, sort of 18 months or maybe it's 2 years ago, we actually lifted the rates of return on both existing investments and new investments for investors, and reduced the amount that we were reserving. And the reason we did that is the reserve fund got to the point of maturity relative to the size of the portfolio and the growth in that portfolio. And over time, we dialed the risk profile down in that personal loan portfolio as well. So the portfolio has got less and less risky over time, or less credit risk in it. As a consequence, we actually increased investor returns. So is that possible for our home loan and construction loan portfolio, and effectively for the managed fund as a result? Yes, but we're not there yet. So that construction loan portfolio is growing nicely. That means we need to make sure that we're growing that reserve fund nicely. It has a pretty comfortable level of cover in it relative to the size of the portfolio, but it's comfortable, not mature at this point, I would say, Alan. And same for the home loan portfolio. The level of risk in there is actually relatively low. There's good cover in that home loan reserve fund, but we're not intending to reduce our reserving anytime soon. To give you perspective on that reserving, so we measure the risk in those portfolios. For our home loan portfolio, it's about 0.04% risk in that portfolio at the moment, and we're reserving at, I think it's around 0.35%. So more than 10 or almost 10 times the risk. So that's a pretty conservative approach. And for that construction portfolio, we're reserving about 0.8% against a risk of 0.4% in that portfolio. So about double. I don't expect to change those settings in the short term. So, let's say between now and the end of the year, we always review them. So we're reviewing those regularly, but in the foreseeable future, so let's say the next 6 months or 9 months out to the end of the year, it's not very good maths, is it? 7 months. I don't expect any changes to take place. But we do review it. We are conscious of the amount of money in those reserve funds relative to the size of the portfolios. And we've shown by past behavior that we've made adjustments to the better or to lift returns for investors in a relative sense over time. Great question. Thanks, Alan. So first question from Bruce. Does it count if you have 4 people in a trust account? Can you claim 100,000 per person? All right. I'm going to be really careful in my definition of a trust account. So let's say it's Bruce's family trust. It doesn't matter how many trustees you have or how many beneficiaries you have. The maximum that Bruce's family trust can get is 100,000 per institution or covered deposit taker. So let's say Bruce's family trust has $500,000 in the entity. It means that entity could spread its deposits across 5 different banks or non-bank deposit takers that are covered and have coverage that way. But it doesn't matter whether you have 2 trustees and 5 beneficiaries. That doesn't make any difference whatsoever. It's more about the entity itself, which is the family trust. So Bruce's family trust. Same thing applies if it's a company. So if you're a company with 3 directors, the number of directors doesn't really matter. The number of shareholders doesn't matter. It's simply that, let's say Bruce's cleaning company will be covered as one entity. So 100,000 with each deposit taking institution that you have coverage for. Hopefully that's clear for you, Bruce. Oh, actually, the distinction there would be if you have 4 people in a joint account, so 4 people jointly have access to that account and are named owners of that account, then you would effectively have 400,000 covered because it's 100,000 per person. Bruce, another example of that would be, let's say you have a joint account with another person and you hold $200,000 in that account with BNZ, then all of that would be covered at BNZ. If you also hold money in an account that is solely in your name at BNZ, Bruce, then Bruce, you have a maximum of 100,000 that you can be covered for. Okay, so it gets a bit tricky when you get into scenarios with multiple people and holdings where you might hold some stuff directly personally and some that you might hold in joint accounts. Hopefully you got more than you bargained for there, Bruce. Thank you for that question and a good one to kick us off. A question from Sally. Why has the scheme been introduced in the first place? Good question. Thanks, Sally. So if you look around other countries around the world, then deposit compensation or schemes or similarly named schemes exist. The US's FDIC scheme is actually pretty well known. Australia has a scheme. The UK has a scheme. You can look at lots of other jurisdictions around the world, and they have schemes in place in relation to some sort of deposit insurance. Um, the reason that they're there is primarily to protect consumers and those with smaller holdings. It's not designed to protect large institutions that might hold, 50 or 100 million or hundreds of millions or billions even with an organization. It's designed to protect smaller depositors. Um, there's been discussion about New Zealand having a scheme in place for a long time. One was introduced for a 2-year period during the global financial crisis, for those that remember what happened through that in New Zealand. It was then removed. The Reserve Bank then put it on their agenda to look at something that might have been a bit more long term and perhaps with a bit more thinking behind it rather than the fairly rushed scheme that they put in place during the GFC. Um, the Reserve Bank has been openly talking about introducing a scheme for the last 2 to 3 years. They've also gone out and sought feedback from the public on the scheme that they are now about to put in place. So that's why it's there, Sally. Hopefully that answers the question. Don't be afraid to give me a follow up if I didn't quite hit on what you were looking for. Thank you. Question from Thea. If someone has a large amount of cash, what strategy is best? If they have 500K, would it be best to have their cash sitting in 5 banks who are part of the deposit taking scheme? Thea, I think that comes down to your personal risk tolerance, and how important you think that guarantee is to you. If you think it's really important, then the best thing to do would actually to be to shuffle that 500,000 across different organizations. So that you sit below the 100,000 cap for each of those organizations. And you manage, if you're growing your pool of money over time, making sure that you manage around it. So if the scheme is really important to you and you want to make sure that all of your funds are covered, then shifting your money across different institutions would be useful. If you believe that actually the banks are all doing a pretty good job and there is unlikely to be any particular risk of things happening in the near term, you could happily leave it all at one organization. So it's going to come down to your risk tolerance and the decisions that you want to make as an individual on whether you split money across different organizations or you hold it, across just perhaps a couple. Yeah, food for thought there, Thea. Thank you. Right. Question from Jeff. I'm hearing suggestions that unsold stock of new terraced houses in Auckland is increasing. What level of exposure does Squirrel monthly income fund to have that type of property? So let's go back to who we lend to begin with, Jeff. First of all, we lend on single house builds and townhouses. Typically, it's not more than 4, although from time to time we might get up to 6 or 7, depending on the situation. It would be very rare for us to get any bigger than that. So do we have developers and builders within our portfolio who are sitting on unsold stock? Yes, we do. Most of them are within their loan term still, and they're still going through their marketing exercise to sell those properties. What we are seeing is that those properties are selling, but it's taking longer than normal. And obviously, developers are looking at the prices that they're able to sell those properties for. And for most good quality developers, they'd rather take a cut in the price and keep moving than hold out for a higher price. Holding out for a higher price comes with a whole lot of sunk costs and interest costs and those sorts of things. So most good quality developers aren't holding out too long. They'd rather sell and keep moving than to sit on stock for long periods of time. We are seeing some of our customers, and I'm aware of this in the market as well, who are saying, actually, I might just hold these properties and I'm going to actually turn them into rentals for the next 2, 3, 4, 5 years, and then I'll look at selling them down the track. So for some investors, if they can keep that capital tied up in that way, then they'll do that as well. So most developers are finding their way through it. You'll see the number of over-term loans in Squirrel's construction portfolio is higher than it is normally. There's always been a handful. It is a bit higher than normal at the moment. Looking through that portfolio, we keep obviously a very close eye on those. There is really only one that we're paying really close attention to. The remainder, I expect, will clear themselves out over time. What's not obvious in the information that we publish on the website is that it's not the same group of loans every month that are problem loans or running over term. There's actually a group of loans that roll in, then roll out, roll in, roll out. So there's constant movement in that portfolio, which is healthy. I guess one other observation is the volume of houses selling in the market has actually been increasing. While house prices are going nowhere, and I don't expect them to go anywhere, kind of at least for the next 3 months, if anything, there's marginally falling. Um, we are seeing turnover picking up. So we're actually getting closer to the average turnover that we've seen in the market if you average it out over a sort of a 10-year period. So that's a healthy sign that we're seeing that turnover, which means that buyers and sellers are finding a way to compromise and agree on a price in the market, which I think is a good thing. Feel free to give us a follow up on that, Jeff. Actually, probably one other thing I should say is that Squirrel's reserve funds are in healthy position, so no particular concerns there. Um, we have lent over $1 billion around that's on around 800 construction loans. And on that 800 odd construction loans, we've had 3 defaults in total. So yeah, portfolios in pretty good health, albeit we always keep a pretty close eye on anything that's coming up towards maturity or stuff that's gone beyond maturity. Thanks, Jeff. How would the money under the trust be covered? Let me go back to that slide and let's have a look. So what you see is a joint account, let's say husband and wife, typical scenario, who are also trustees of a family trust. So under the joint account, um, they have 200,000 per bank that they hold money with, assuming that they've got a joint account with both organizations, so Bank C and the non-bank deposit taker in this example, because each person has 100,000 per organization. Okay, so in total, across those joint accounts held in personal names, they have 400,000 covered. On the right-hand side, for the family trust that they could be trustees or beneficiaries of, doesn't really matter. They have 200,000 covered because they've got a maximum 100,000 invested with Bank A and a maximum 100,000 invested with Bank B. So the family trust itself has 200,000 covered. So hopefully it answers the question for that. So individually, they have 400,000 covered under those two organizations because they've got joint accounts on both organizations. And the family trust is one entity, so therefore it has a maximum of 100,000 coverage for each institution that it holds money with. So that family trust, let's say it had 500,000, it could actually hold 100,000 with 5 different covered deposit takers, and all 500,000 of that would be covered in that situation. This question from Jeff. Approximately what percentage of construction loan applications make it through the Squirrel process to become actual loans? Hard question to answer, Jeff, because all of the Squirrel loans are sourced through Squirrel advisors. So we don't take loans from the market. We don't have other brokers who provide loans to us. All of them go through a Squirrel advisor. So it's the Squirrel advisors who are actually the first point who will determine whether they think a loan is worthy or not. So they'll then work with the borrower, create a submission that then goes into our credit team. We rate our advisors pretty highly. That doesn't mean we don't apply great credit processes, but by the time it gets to our credit team, most of the loans are in pretty good shape, or the submissions are in pretty good shape. There's often some to and fro with advisors. We will decline them from time to time, but most of the loans that arrive from one of our advisors are in good enough shape to go through, albeit we might give them a bit of panel beating and adjust the loan to value ratio or move things around a bit. So yeah, there's quite a bit that goes into that process. But I couldn't actually give you the percentage, Jeff, because I think a lot of the loans that are never going to make it never actually make it to our credit team because our advisors are batting them away. Or if they don't fit the credit, the Squirrel credit profile, they'll be taking them to a different lender. So for example, a 10 townhouse development that typically wouldn't fit within what Squirrel's interested in. And therefore they would take that loan elsewhere to other property development funders, as an example. Thanks, Jeff. Question from Niraj. What's the current interest rate on the Squirrel monthly income fund? So the fund's returning around about 6.5% per annum at present. If I got out my crystal ball and I look into what's going to happen in the future, I fully expect to see the official cash rate fall. I expect to see lending rates and deposit rates continue to come down in the market. I expect the low point for the Squirrel Monthly Income Fund will be, I'm going to say 5.75%, around about. Clearly this is, I'm looking forward and please don't rely on that. But that would likely be the low point in this interest rate cycle. So over time, assuming a normal interest rate cycle, so not a COVID-like interest rate cycle where interest rates went to zero, I'd expect the monthly income fund to return between sort of 5.5, 5.75 at the bottom end and 7.5 at the top end. Key to all of that is our goal is to produce a return for the monthly income fund of 2 percentage points higher than bank 1-year term investment rates. Okay, so a bank term and 1-year term investment rate today is probably around 4%, high threes, early fours in that zone. We're at about 6.5-ish at the moment. So we're a bit over that 2 percentage point margin that we attempt to get to. For those who've looked over time, you'll know that at the very top of the interest rate cycle, so when the monthly income fund was returning about 7.5%, a bank 1-year term deposit rates got to about 6%. So we were undershooting that 2% goal by about 0.5%. At the moment, we're over it by about 0.5%. But on the long run, the goal is a 2 percentage point higher return than a bank 1-year term investment rate. Thanks, Niraj. All right, looks like I've got another scenario posed at me. Let me see if I can read it out, decipher it, and then give you an answer for it. So in the example, and I'm assuming that's the one that we've got on the screen at the moment, for the joint account, the wife had 100K in bank A and 100K in bank B, and husband had 100K in bank A and 100K in bank B. So that means 400,000 covered. 100% right. So it doesn't really matter whether it's held in joint accounts or held in your own name. You have 100,000 cover per person is a way to think about it. So whether you holding the money in joint accounts or you're holding it as individuals, you have a maximum of 100,000 per person per institution. Okay, I think that answers the first one. Thank you. And then I think I've got another scenario. Could be from the same person. If you have a joint account with someone at ANZ and you have 200K in the bank jointly, the entire 200K is covered. That's correct. Let's say the same couple have another joint account at Kiwibank for 200K jointly. They have 100K covered each with that joint account. So yes, that's correct. So you've got 100K per person per entity. If you happen to have joint accounts, then you can kind of treat it as 200,000 in that joint account in total, assuming it's two person that are joint holders of that account. So I think we're starting to get there on that one. Thank you. The next question, which is a good one for the other side of the ledger. So if a bank were to go under, what happens to people with debt? So, or mortgages, let's assume. I assume they don't disappear. And there's a laughing out loud after that. And that's quite true. That money is still owed to that bank. So yeah, the debts don't get wiped, unfortunately. Thank you for that one. Question from Jeff, for construction loans, is interest paid over the term of the loan or does it accrue and get paid at maturity? So for our construction loans, on the investor side, all of them are interest only. For the borrower themselves, we have a mixture of interest only and interest capitalizing loans. So in effect, we're funding that interest during the course of the loan. where it's an interest capitalizing loan. So there's a mixture in that portfolio, Jeff, of both interest only and interest capitalizing loans. I don't have that split off the top of my head, sorry, of what portion of limits are interest only and what portion of limits are interest capitalizing. Yeah, I just don't have that one off the top of my head. Sorry, Jeff. Thank you for that question. For 100K invested with Squirrel in construction loans, is that covered? The answer is no. So any investments in Squirrel's monthly income fund or our construction loan or home loan or personal loan term investments is not covered by the deposit compensation scheme. So just making sure that's really clear for all of you. Thank you. All right, I've got a question here from Jason. Regarding the deposit insurance, I assume it only kicks in for multiple people if the account is named in both holders. A lot of joint accounts nowadays are just adding signatories to an account instead. So quite sure how to interpret that. If you're an owner of that account, so if you have the ability to act on that account, then I would consider that you are an owner. So your name would need you would need to be named on that account. So if you went and looked at that bank account or looked at a statement, it's the names of the account holders on that statement that would dictate who is covered. If you're referring to a situation where enduring power of attorney is in place, Jason, if that's where you were going with that question, then I don't think you are named as an account holder. You simply have signing rights on that account. So in that situation, so let's say, if I was looking after money on behalf of my mum, and she had money in her account, it would be in her name, but I have authority to act on it. In that situation, mum would have $100,000 coverage, and my holdings are treated separately from hers in that situation. I think that's the case, Jason. And if that's what you were getting at, hopefully I've answered that one for you. Thank you. Question from Sally. There is still no protection for investors who give deposits to a development group who claim to be funding their own builds. That is correct, Sally, unless they are named on that list that I pulled up earlier. This one here. Unless they're named on that list, and I assume that list will get updated by the Reserve Bank as different organisations come and go from the list, they do not have cover. The only way a developer might have cover if the money that they're holding is in cash and held on trust for the underlying investor. But if they're using that for development funding, they're going to be spending that money, and therefore it's unlikely to be covered. So, Sally, I would tread very cautiously in that situation. If you're going to invest directly with a developer, and they're doing, they're going to be using that money for that development, chances of it having deposit compensation scheme coverage, I would say, are very low. And the only little quirk there is if the money is being held on trust in, for example, a bank account or with a non-bank deposit taker, until that developer needs it. So if the developer or if the bank went under or the non-bank deposit taker went under, then you would have that cover. If the developer goes under, you're not going to have any cover unless the money is being held on trust for you with one of those deposit takers. So you're in kind of niggly territory, but I would say tread carefully and do your due diligence before you make a decision around that. Sally, thank you. Question: has a bank ever gone under in New Zealand, or has it happened, or has it not happened because the government bails it out secretly? Okay, so what we know in New Zealand is that I'll call it recent history. So if we go back to from the 1980s through till now, BNZ was effectively bailed out twice by the government. That was public, very public, both times. And if I understand correctly, Westpac got close at one point, but I don't think it actually happened. That was in let's say, the bad old days of the late 80s, early 90s, and what was a terrible recession that New Zealand went through. And effectively, it was some mortgage commercial mortgage-backed lending that went bad for both BNZ and Westpac that caused them to get into trouble during that period. So I don't think it would be a secret if a big bank was going to be bailed out. That wouldn't be in the public interest for it to be secret, would be my opinion. Um, yeah, thank you for that question. So has it happened? Yes, it has happened. Are banks safer today than what they were back in let's say, the late 80s, early 90s? Yes, they are. Yep. So the Reserve Bank's done a lot of work in that space, from, we'll call it, prudential supervision and rules that they've put in place to make sure that banks are relatively conservative institutions and they act that way, and are monitored and hauled over the coals if they're not acting in that way. Um, you've seen, yeah, I could go on for a long time about that, but I'll pause that question there. Thank you. A follow-up question here from Jeff. Interest capitalized construction lending. How do you ensure the loan stays within the LVR? So when we set the lending limit on a particular, let's say, an interest capitalizing loan, we are taking into account what those interest costs are expected to be over the maturity period or over the life of the loan. Okay, so we set the LVR. Let's say, for most of our development lending, the maximum LVR would be 70%. The portfolio on average runs at about 60%. So let's say we've got $1 million, a property that we expect to have a finished value of $1 million. Our maximum LVR would be 70%. So the maximum loan at maturity date would be 700,000. And the amount that we would then lend up front will be somewhere less than 700,000, less the capitalized interest amount. Let's say there was going to be 100,000 of capitalized interest. So the maximum amount of principal that could be drawn on that loan would be 600,000. And typically those loans might start at, let's say, 300,000, which covers, cost of land, etc. And then we'll build up to 600,000 having been drawn by the borrower. And the allowance for that capitalized interest is untouched, or is allowed for when we set that LVR to begin with. Great question. Thanks, Jeff, for that follow-up. Is there a plan to set up joint accounts for mum, dad investors? Yes, there is, Mark. We are expecting to deliver that, I'll say, early next year. It's definitely on the roadmap. I was hoping that we'd already have it in place, but we've had a few other things that we've needed to do in the meantime. So unfortunately, we've had to kick that down the road a little bit in our roadmap. But 100%, we expect to deliver joint Squirrel accounts for investors. We also expect to deliver accounts for under 18s. And also, we expect to deliver accounts where you can operate on behalf of someone. So let's say, I'll use the example of my good old mum right now. So if she's got money and I'm going to operate that account for her, it allows me to kind of connect my account with hers. Obviously, we need to see documentation and authority for that to happen, but we'll also allow that. So we've got a whole range of things in that kind of entity setup, if I describe it that way, that we aim to deliver. It's clearly on our roadmap. We know how we're going to do it. We've got some other things we need to do first. I expect that we will be delivering that sort of early-ish next year, or by this time next year at the latest. All right. Has a bank in New Zealand ever failed without being bailed out? The answer is no, to my knowledge. So I'm going to qualify that with a to my knowledge. It could be that there were banks, I'm going back a long way now, that did fail and weren't bailed out. There are definitely finance companies who failed and weren't bailed out. And there's probably credit unions and building societies that may also have failed going back in time. In recent history, the biggest list of failures that occurred that didn't have cover were typically finance companies through the GFC period. So that's kind of 2008 through 2011 was that kind of the high stress period on that one. And thanks for the compliment on the way I'm answering questions. Appreciate that. I'm doing my best. Thank you. Kiwibank is owned by the government. Does that increase the chance of protection? Well, you'd say the government's a pretty good shareholder to have on your register in that sense. Um, would Kiwibank be bailed out by more? Well, I think that will only ever be tested if it were to take place. And I don't think you could rely on that occurring. Um, the reserve banks put these rules in place in consultation with the government to make it really clear what you as an individual, either as a personal entity or a trust or a company, can expect to have covered if you're holding money with one of those covered deposit takers. So let's say you were holding 300,000 with Kiwibank, that fell over, would you get all 300,000 back? You'd be spinning the roulette wheel on that one to make a definitive call, and I'm not going to make a call on that today. Um, if you look around the world, typically governments have backed big banks if they're going to fall over. Smaller ones they're probably less worried about, but they're worried about the systemic risk of a big bank falling over. And yeah, I'll get into some, arcane territory if I go on about that too much, but the systemic risk of a big bank failing is pretty severe, which is why during the GFC you saw government stepping in and bailing out often quite a lot of big banks in other countries around the world. In New Zealand, they didn't bail out banks. They did make funding available to them, and they did put a deposit guarantee system in place. For my sins, I was actually at ANZ at the time and was working on how we worked out how much money we needed to pay the government for the deposit guarantee scheme that came in during the GFC. So that's probably where I lost most of my hair at that point, would be fair to say. Thank you for that. Question from Bruce. Thanks for your time. I've enjoyed the seminar, but he's off. Oh, Bruce, there we go. I'm glad you've enjoyed it. I'm glad you've got something useful out of it. To the 40 odd people that are still on the call, I'm going to close it there unless you're typing furiously and another question pops up. If you have feedback for me, don't be afraid to let me know on dave@squirrel.co.nz. If you have follow-up questions around scenarios or things that you want to check on, send it to money@squirrel.co.nz and I'll do my best to answer those along with the team over the next couple of days. Thanks very much. Chat to you again soon.